Good day, everyone. Good afternoon, everyone. It's such a pleasure to be here to present this paper titled Machine Learning for Financial Statement Analysis and Forecast, using the case study of a bank that is listed in the Nigerian Stock Exchange market, called Guarantee Trust Holding Company PLC. And I'm sure most of us from Nigeria, we know this bank to be called the GTB Bank. So I'll be presenting today on this research, and this research actually it explores how machine learning can be used to be able to generate machine learning models that can predict. This research will be able to explore how machine learning can be used to be able to augment or replace the traditional financial statement analysis in the Nigerian stock exchange markets to help investors make data-driven decision in their investment decision whenever they are making investment plan. And during this research, we would explore how we've been able to use machine learning to generate models that bring about a paradigm shift in the Nigerian stock exchange market to be able to help investors to be able to analyze and predict straight like predictions in data and help them make financial decision accurately. And for this research was majorly motivated by a deep lack in the financial knowledge of investors. I believe many of us here, we are so interested in investing in the financial market. We want to have one stock or the other, or we want to have several investment portfolio. But the problem is we lack the financial acumen in analyzing the performance of the company that we want to invest in. And if we lack the financial acumen in analyzing the performance of a company we want to invest in, it leads to us making poor investment decision, and then it leads to losses at the end of the day. It leads to losses which make us lose money at the end of the day. And this problem is very, very paramount, whereby we see many investors, they focus majorly on the general metrics that has been informed to them. For example, if someone wants to invest in a company listed on the stock exchange market, we've been told to focus on certain metrics to determine the performance of the company. For example, maybe their return on investment, their ROA, or dividend yield. And these metrics are not only the metrics that we should focus on to be able to determine the performance of this investment or this stock in the Nigerian stock exchange market. So based on this problem, based on this gap that I found when people are investing, the lack of financial knowledge when people are investing to be able to accurately analyze the performance of companies or whatever stock they want to invest in. So I saw the opportunity to work on a research that can use AI, that can use machine learning to develop models that can help investors to be able to predict and make financial decision, good and accurate financial decision. And when we are talking about financial analysis is usually done traditionally. My background, I studied accounting, and my master's is in business administration. So when you're analyzing the performance of a company, there are different methods that can be used. And majorly, this method are done traditionally. There is the horizontal financial analysis, and there is a vertical. But these analysis take time. And imagine someone that does not have the financial background, that does not have the knowledge on how to carry out or how to go about this financial analysis, and they don't have the in-depth knowledge or the acumen they need to use in evaluating or analyzing the performance of the company. They end up at the end of the day making bad financial decisions. And based on how the stock markets can be very volatile, I'll use an example of the the stock exchange markets with the recent happenings of the 100% tariffs that was imposed on China by US. So that kind of caused like a shift in the stock exchange markets, whereby the prices of stocks, the prices were very down. And let's say, for example, if someone wants to invest during that period, it would be very hard for them to make a decision, or to make the right decision of the stock that they can invest in. So that's why this research is based on how we can generate machine learning models that can help investors, that can take the burden off them, to help them predict the performance, to help them predict the market, and help them make the right investment decision. And while conducting this research, I realized that there is actually a huge gap in the application of machine learning in the Nigerian bank sector. So there is not too much of application of machine learning models, where the Nigerian bank sector, or the Nigerian stock exchange market in general, there's not too much research that people have used this machine learning or AI to be able to enhance like stock prediction, fraud detection, or to basically forecast globally. So this was one of the gaps that was discovered during the search. And this search, there are three main objectives from this research. And the first objective is to be able to predict the financial health and profitability of a stock. So the main aim of this research is to be able to develop a model that would help investors, that would help people that are willing to invest in the stock exchange market, to be able to predict the financial health and profitability of a company, or whatever stock they want to invest in the stock exchange market. And how this was done, or how this was achieved in the case of this research, the company, which is a case study, which is GTB Bank, the annual result over the year of 12 years was traditionally analyzed, and then it was later trained. Different sets of models were later trained to be able to make the same decision, to be able to predict or to give the same results. And we are going to talk in-depthly about that during the presentation. And the second objective is to be able to enhance investment decision. So when people are investing, the aim of the research is to be able to take out, or to be able to take off the burden of people that are prone to make bad investment decisions. So it helps to enhance investment decision. And also the third objective is to be able to help advance machine learning in finance, most especially in the Nigerian stock exchange market. So this research brought about like a paradigm shift, where we have something that can replace the traditional financial statement analysis, and then bring about analysis from manually to automation. And for this research, the model that was used, as I mentioned previously, the financial statement analysis are done traditionally. And I mentioned earlier as well that there are certain metrics that you need to watch out for as an investor when you're investing in the Nigerian stock exchange market. Not even only the Nigerian stock exchange market, the stock exchange market in general. So you are not only looking out for the dividend yield to be able to know how much dividend you would get on an investment, maybe over a certain time, over a year or financial year. You're not only looking at your dividend, you're not only looking at the return on investment, you're not only looking at the total interest, but there are certain metrics that need to be analyzed to be able to determine the overall health of this company and the profitability. And sadly, most investors, they don't really know about these metrics that needs to be analyzed in-depthly to make their decision, to make decision accurately. So during this research, the annual report of GTB was analyzed using all those metrics. So these metrics were extracted from the annual report of this bank, which is listed in the Nigerian stock exchange market. It was extracted and analyzed traditionally over the period of 12 years. And then these metrics were then the result, or what we derived from the traditional analysis of their financial reports, were then trained into into a machine learning, and then we were able to develop algorithms that can help investors to make data-driven investment decision, and then improve their investment plan, or improve the result that they get from their investment, or from their financial investment. So the methodology, as I mentioned, we use a mixed methodology approach, where there are quantitative financial analysis, and then there is also qualitative for the literature review for over 12 years. And from 2009 to 2022, an horizontal traditional financial statement analysis were carried out, and then using 4 machine learning algorithms, which I'm going to talk in details about. 4 machine learning algorithms were used, they were trained to develop models that would help to generate or predict the performance of a company. So we mentioned financial ratios. The financial ratios, which are the metrics that were calculated traditionally, were then trained into a model that would help investors to make decisions. So the 4 algorithms that were used were random forest, k-nearest neighbor, logistic regressions, and naive Bayes. And these ML algorithms were specifically chosen because of their abilities and how they are relevant to this research. So for example, for random forest is a machine learning technique that is used for for classification. So it is used for taxes as like classification, regression analysis, and feature selection. So based on our research, there are certain results, classifications that were selected, and random forest algorithm was the best machine learning algorithm that is suitable for this research. And I must say as well that the machine learning that we use for this research, that was used for this research, was a supervised learning. So a supervised learning in the sense that our models, they have the understanding of the results or the outcome that we should have. So we were able to analyze manually, and then we train the models to be able to give a particular outcome. So the machine learning the analysis were done traditionally first, and then the results were fed into the models to be able to train the machine learning to give a particular outcome. So the machine learning has an idea of the outcome that it should give. It's not just giving random results, it's not giving random outcomes, but it has been trained and it has been given a particular outcome that should generate based on our traditional financial statement analysis. And the next is k-nearest neighbor. So for non-pragmatic algorithm, classifying data point and proximity to nearest neighbor. So this algorithm was the best because it has simple implementation and is adaptable to diverse data sets without destruction of assumption. So this was one of the reasons why this model was chosen for this research, because it has a very simple implementation and then is relevant to the research, is relevant to the purpose of this research. And for logistic regression, it has like a statistical technique for binary classification problems, because while we were analyzing this, when we were training the model, we couldn't impute numbers, which I'm going to talk in detail. So the result gotten from the traditional financial analysis could not be imputed like in numbers, like in percentages, or in fractions, just like the way we got it for the traditional model analysis. They were converted to binary. That's why logistic regression was very suitable for this research. So this result, or the outcome that we got from the traditional financial model analysis or financial analysis, were converted to binary to be able to train the model to be able to give the outcome that is needed. And then the last algorithm that was used was naive Bayes. So naive Bayes, because it is independent, it performs well with high dimension spare data, is fast and accurate for classification tasks. And as I mentioned, an experiment was done. For this research to be able to be complete, we had to do an experiment, which is to train the models that we've selected, the algorithms that we've selected. So over the period of 12 years, the annual report of GT Bank was traditionally analyzed, and then each result of each year were converted in binary. That's why we have here in 2009 the numbers was 0 or 1. So this 0 and 1, they indicate like certain results. So if the result in 2009 was 0, which means the final result based on each of the metrics, like for example the return on investment, the dividend yield, the income statement, like all those metrics that were specifically extracted from the annual report of GT Bank in 2009, based on the performance of the company at that year, the results were and the decision was not to invest because they didn't perform well. And based on the result of each year on each matrix, it is not advisable for investors to invest into that stock at that year because their performance were quite low. So the result was converted into binary and then it was 0 and it was not to invest. So this result was fed into our 4 machine learning models. It was fed into random forest, k-nearest neighbor, logistic regression, and naive Bayes. And based on the results that random forest was given, according to his prediction, like we fed the model the results from each year, and according to his results, his own performance was 0.5. So out of 1. So if 1 is the result to invest, and 0 is the result not to invest. So out of binary, his result was 0.57. And then for k-nearest neighbor, the result was 0.80. For logistic regression, the result was 0.50 and then 0.69. So based on this, the results at the end of the day, it was partial. And then the concessions, like the decision that all these models could give from these 4 models, the decision we could is just mixed. We cannot really predict. We cannot really go with the results that these models has given us for this particular year because they are not really close to the decision that we want. They're a bit, some are far away, like random forest is a bit far away, and then it's like a mixed decision. We cannot really decide, like, okay, which one, their outcomes were a bit mixed up. Their outcome is a bit mixed up, so we can't really decide on which algorithm is best in predicting results for this year. And in 2011, the decision was to invest because the company performed well. Their performance was very good, and then the decision was to invest. And the result was converted into binary, which is 1. And then these algorithms, they predicted the result of this year. And for random forest, it was 0.92. For k-nearest neighbor, it was 0.82. And then for logistic regression, it was 0.91. And then for naive Bayes, it was 0.95. So as we can see, they're all close to 1. Their percentages was higher. It was close to 1. So they gave like a perfect, accurate like results that is close. So we could take like all these algorithms, we are able to predict perfectly that the algorithm or their predictions were perfect, which we can go for. And then everything, each was done, each analysis was done for each year, and then we could see that in 2011 there was perfect decision for each algorithms. In 2012, in 2013 as well. So in 2014 there was like a partial decision, like it wasn't totally accurate. It wasn't their decision that they gave, like not majority of them, like not all of them, like certain matrices, like out of 4 metrics, only 3 were able to predict accurately. So we cannot say that in 2014 all our algorithm gave like a perfect decision. We can't say like they gave a perfect decision. It was very partial. So we can't say this year all the random or all the algorithms were able to predict well. So and this followed for each of the years. So these were the results that we got. And out of 12 years, they were able to predict, like the models were able to predict like perfectly. For all of them, they predicted for just 10 years. So and this we could see in the they were able to predict perfectly for 10 years. And then for the performance of the metrics, so we have certain performance metrics that we use to analyze how well these algorithms were able to predict the results that we want them to actually predict from this research. So we have a metric called the area under the curve. So the area under the curve is like a common indicator used to estimate the discrimination ability of this classification model. So how well how well are they able to discriminate between the results and also between the results that were derived traditionally? How well is like the discriminatory estimation? Like, is there any discrepancy in the result that was fed into the models? Is there any discrimination? So for the random forest, for the area under the curve, random forest was very perfect, and k-nearest neighbor was a bit low. Logistic regression as well was was perfect as well. So 3 out of area under the curve for the estimation of the discrimination. Only one model didn't predict perfectly. It didn't predict perfectly, but 3 algorithms out of 4 algorithms predicted perfectly. And then the classification accuracy. It quantified the percentage of the occurrence or percentage of the occurrence properly classified out of all the instances. So out of all the instances, obvious, the occurrences that were perfectly classified, that they were able to classify each accuracy perfectly. Okay, random forest was not able to. It did better than other. It wasn't really able to classify perfectly because it wasn't up to 1. If you remember, our binary code was 0 to 1. So from 0 is not to decide, and a perfect 1, a 1 is like perfectly, they predicted perfectly. But for classification accuracy, our random forest algorithm was not able to perfect accurately. It has a 0.917 prediction ability. So it couldn't predict perfectly. And then for k-nearest neighbor, it couldn't predict perfectly as well. But for these 2 algorithms, they were able to predict perfectly. So they have like a 1 binary result. So their result was perfect. They were able to predict. They were able to, their results from the training to our results from the traditional analysis, they were matching. So we can say that these 2 algorithms, they were able to predict well. And then for precision, so precision is how precisely were they able to predict, were they able to generate the outcome that we want them to actually generate. So precisely these models, the first model, the random forest model, wasn't able to predict precisely about the algorithm. It couldn't predict the result. It wasn't precise at all. So for k-nearest neighbor as well, it wasn't precise. But for these 2 algorithms, they were very precise. They were very, very precise. And then for the recall is out of all the occurrences. So for each instances, how were they able to remember, like to be able to recall all the result that was gotten. I remember one of the speakers that was saying is what we feed the AI is what we would give. So we've been able to feed this algorithms results from traditional analysis. So how are they able to recall the result over and over and over and over again to be able to say, okay, this algorithm is perfect for prediction. So when we are generating, maybe when we're generating algorithm, how can we say, okay, this is the best algorithm, or we are trying to predict a result? Which algorithm is best? Which algorithm is best used to analyze or to be able to use in predicting results? So these 2 algorithms were not perfect at all. They couldn't really recall their results. Their result was very low compared to these 2 algorithms. So in all the classification, logistic regression and naive Bayes were the perfect algorithm that were able to predict accurately. So I forgot to mention earlier that this research was also done to be able to generate like a platform in future whereby as an investor you don't even have to go to maybe your investment platform to be able to check, oh, which company am I going to invest in. All this, the algorithm will be imputed in a system whereby it gives you the result, it gives you the prediction. Okay, this stock, for example, I'm going to invest in Nvidia, is going to tell you at this season, based on all the metrics of Nvidia, when this machine learning, this algorithm is imputed in the system, it's able to analyze the performance of Nvidia over a certain number of years, and then it's going to tell you predictions, is going to advise you on decision that you're supposed to carry out. So it's going to tell you everything that, okay, this Nvidia stock in the next couple of years, it has the potential of performing well, it has the potential of doing this. So it's going to basically give you like a breakdown decision on all your investments, all the investment information that you need to know on the Nvidia, and then it predicts how this company would do well in the nearest future. So out of these 4 algorithms that were chosen, only 2 algorithms were able to predict perfectly, which is logistic regression and naive Bayes. And in this research, there were certain confusion metrics and classification analysis. So in naive Bayes, we were trying to analyze like if there were like confusion metrics, like for example, in the traditional analysis, in 2009, as I can recall, the decision was not to invest based on the performance of the company. Now, we were able to train the model to check if there's like a confusion, like were they able to accurately get the decision to be able to predict accurately from this result that was trained to the system. So for example, in 2009, the result was not to invest. So these models, these algorithms, did they give the wrong decision? Because we need to actually check if our models are actually giving us the right results. I remember I was in a meeting last week where we were checking ChatGPT, and I got the information that even ChatGPT now, they're giving wrong information. And if you don't vet the information of this algorithm, because these are machine, it has to be trained. If you don't vet their information, are they actually giving you the right information to make your investment decision? So in naive Bayes, now true negative means that in the traditional analysis, is there any result that was true, but then the model gave false? So if there was a result that was true, but the model gave false, so there is like a confusion in the metrics. So there is a confusion between the metrics of the traditional financial analysis, and there is a confusion between the machine learning analysis. So for naive Bayes, so for true negative, it was just like 3 confusions. There were just 3 confusions. And for true positive means, okay, in the traditional analysis, did we train the machine to be able to decide to invest? And if we train the machine to be able to decide to invest, did the machine actually predict the result to be able to decide to invest? So these were the results. So out of true negative, which was the first one was invest, but then the machine gave the negative result of not invest. So the true negative was just 3, and then the true positive, which is invest, and then the machine gave to invest, the confusion matrix was 3. And then for logistic regression as well, if you remember logistic regression and naive Bayes, they were the best classification. They were the best algorithm that were able to classify our algorithm precisely. They were the perfect one. So this result as well was very similar to naive Bayes because their prediction was 100%. However, when it comes to random forest and k-nearest neighbor, they have so many confusions. So we can't really rely on these algorithms to be able to give us the best results. So algorithm to give us the result on investment, we would definitely make poor investment decisions. So we cannot go with this. We can't go with this. We can't go with this algorithm to help us decide on what to invest in. But these two results above, which is naive Bayes and logistic regression, they are the best algorithms that we can employ, that we can use to be able to help us make investment decisions. And for the conclusion, so this research has been able to be able to outperform the traditional analysis in the Nigerian stock exchange market or in the financial sector. So instead of analyzing the performance or to be able to determine the performance of a company, so this machine learning has been able to outperform the traditional financial statement analysis. So based on the result that we can get from naive Bayes and logistic regression. So we can now say that, oh, we have an algorithm that can help us, that can ease us the burden from analyzing financial statement traditionally, like going through annual report of 10 years, 20 years. Now we have an algorithm that can help us to analyze them and take up the burden from us, and we'll be able to do that. So an algorithm, we have a machine learning now that can help us. So now in this research, there is like an 100% accuracy model from this research. So now we have two algorithms that predicted perfectly to be able to be able to predict and help us make better investment decision. So now we can say now we have now an automated forecasting. So like I mentioned, so this has been able to bring like a shift in the financial sector. So instead of doing analysis traditionally, so now there is a model that can do it, that can automate it, that can do it instantly, that can do it spending time. And this does not only benefit the investors, it also benefits the internal users in the sense of financial analysts, those that work in the internal sector. So you have brokers. It does not just benefit the investors, it benefits the internal users of the stock exchange market as well. So now through this research, through this model that has been generated, so we can now say there is a model, machine learning model, that can help us make data-driven insight, like it can help us to predict or help us make better investment decisions. So there will not be losses in our investments, and then we make investment decisions that actually benefit us. Thank you so much. If there's any question, I would like to take the questions now.
Thank you so much. That was just an amazing presentation. Please, a round of applause for Ms. Ayomide. That was just awesome. Very precise, very clean, and very detailed. So at this time, we have one question in the chat I'm going to run through quickly. In what ways can human emotions such as fear, greed, optimism, and panic be quantitatively modeled and incorporated into machine learning systems for predicting financial market behavior?
Yes, thank you so much for this question. In what ways can human emotions such as fear, greed, and optimism? So as I mentioned, these algorithms that has been used, that the way we analyze the machine learning, for example, the analysis was done traditionally first. So over a certain number of years, the algorithm would help you to analyze the financial report or the performance of this company to be able to help you make data-driven investments. So now the machine learning itself, of course, AI is not, it doesn't have emotions, but they are giving you factual data-driven predictions. So once this algorithm and machine learning has been able to, let's say, for example, in the example of this research, machine learning has been able to analyze, has been able to give you decisions that that based on my own prediction, based on my own analysis, this is the best decision for you. So they make the best decision, but then that would help you curb, because that he has he has done his analysis over a number of years, so which you yourself cannot do. So we can say that the result or the prediction that this machine learning is giving is actually fair, is actually true, which you yourself, if you have done the analysis, you may not be able to achieve the result. So I think with the analysis of the machine learning, it can be able to curb greed up to, and fear, because he has done the work for you. You don't have to stress. You don't have to go through the the energy or the stress of you analyzing, and then takes off those emotion. And of course, I must say, when investing, even if machine learning give you the result or the prediction, you still have your choice. You have to take the decision. It's just predicting, it's giving you a certain result. So the decision as well is based on you to take that decision. So that's how I'm going to answer the question.
Awesome, awesome. Thank you so much. I just want to emphasize again that AI is a tool. We are supposed to use it and not be totally dependent on it. And so when it comes to investing, it's very good that you build the habit of making your own research, or start off with ETFs, which is always a combination of different companies in one place. This helps you to be on a good balance as opposed to buying one stocks. Thank you so much again, Miss Ayomide, for your presentation. Please, a round of applause for her as she clears the space.